As a trading coach here in Australia, I'm always getting asked how to identify supply and demand zones. So I figured it's time I do a video on order blocks to show everybody how I identify and trade supply and demand. So let's take a look. Welcome YouTubers, my name's Donnie and this is my channel The Next Gen Investors, where I share tips and education on trading, investing and personal finance. If you find any value in what I share with you guys today, feel free to hit the like button and subscribe because it helps me to grow the channel so I can continue to create quality content. Now this video is actually long overdue. I'm predominantly a swing trader and I use a combination of trend and range trading strategies that both incorporate the use of order blocks. Now you might be asking, what is an order block? Order blocks, or often referred to as institutional order blocks, are a defined area where large amounts of buyers and sellers entered the market to move the price away from a consolidation zone to a new area of interest. This strategy is heavily based around the economic theory of supply and demand. You see, financial markets are actually engineered by smart money in order to create levels of interest to be used at a later date. The same theory applies to the likes of support and resistance, as these levels give traders and investors an idea of a safe area or level to enter and exit the market based on the previous consensus of other traders. The order block strategy is attractive to professional traders for a few reasons. Firstly, the theory is you have big money on your side instead of getting caught up in the noise and patterns that are formed by emotional retail traders. Secondly, and this is my favorite part, it often offers a much higher risk to reward as your entries are a little bit more precise, your stop losses are smaller, and your targets are quite large. So, how do we identify these order blocks? It's actually pretty easy. After a period of consolidation within a tight range, we are often met with an increase in volume and an impulsive move from the range. This indicates that large buyers or sellers have entered the market to move it into the direction that they desire, which creates a massive imbalance of supply and demand. If the range breaks down, this indicates an increase in supply in the market. If the range breaks up, this is indicating an increase in demand. So let's head over to the charts and take a look. So here's a basic downtrend that we then move into a sideways range or a consolidating range. What we're looking for is the move out of this range to find out where the supply or demand is. Now in this case here, if we were to rally up towards the top of this range, but then break down below and start to head down like this, then this area here would be a level of supply where there was a massive imbalance between supply and demand, indicating where there is, overhead resistance in this case. Now, in the case of a demand zone, we're looking at this consolidation range, and what we'd actually see is a push down, indicating that last sort of chance for the sellers to step in, and then we'd see that imbalance happen and would start to see impulsive moves to the upside. Now, this is indicating that a level of demand was created back here, and we can now use this for our trade strategies at a later date. So this is a zoomed in version of a supply zone. So you can see here we've got this consolidating range. I'm looking for that last bullish candle before the market really fell out and the supply took over. So I would draw my supply zone from the wick down to the body of this hammer. So here's a nice zoomed in version of a demand zone. So you can see here where we had this consolidation, the candle I'm actually looking for is this spinning top right here. Now it doesn't have to be a spinning top, doesn't have to be a doji or a hammer, it could be anything, that's not really important. What is important is we're looking for the last push down out of this range before the buyers really stepped in and took over the demand of the market. So I would draw my demand from the wick of this bearish candle to about the body, and that would indicate my demand zone. So that's how we identify them, but how do we trade them? There are numerous ways that we can trade supply and demand zones, like a range trading strategy and basically placing orders on these zones and swinging it between a larger range over a longer period of time. Now when it comes to a trend trading strategy, these areas are more or less targets or take profits. If you're already in a trade or you're maybe trading off an EMA or something, then you might look to take profit at the next supply block. So let's just jump over here and have a look at the chart on Bitcoin, and we can see that we were stuck in a range here back in March. Now, we also saw an impulsive move after we had that increase in volume to really push us out of this range. So what I like to do now is come over to our rectangle tool, and I would select this last candle here before the breakout. So I'll just extend this up to about here. Again, this is where people's own discretion will come into it about how they want to draw it, whether they go from wick to wick or body to body, wick to body. Everyone's going to do something different. I like to just keep it at a reasonable size. I could extend this up to the wick, but then I'd start to be increasing the size of this box a little bit. I'd like to just keep it down to about here. Now, you may not actually take action and enter any trade right now, but what we're actually looking for is a retest on this zone to confirm that this demand block is actually here and we can actually place a trade on it. So I'm just going to push play now and we'll wait and see what happens. So what we can actually see now is when we came back to retest this demand zone, we got a lot of wicks to the downside, which confirms that there was a lot of buyers entering the market in this zone. We had an increase in volume starting to increase over time. So this gives us a pretty good indication that there is a lot of buyers in this area. Now you can choose to either enter in the demand zone, you can maybe enter on a candle close above, or maybe you're just wanting to see that bounce and a retest or something like that. Everyone's going to have their own way to pinpoint their entry, but the idea is we want to see that this level is confirmed as a level of demand and we can place our trade after that. So let's just assume that we got into a decent long position from down here. We're going to see how this plays out now. And we can see that there was a pretty good incline in price after that. So there are obviously a lot of demand happening in the price action. I'll just keep pressing play and we'll see how this level gets respected later on. So as you can see, when we came back to that zone, we still had big buying pressure within this zone. But the only thing is we actually pierced through that zone. Now, again, everyone is going to be different here, but this is the way I do it. If this zone actually gets penetrated through or is pierced through, I now consider this zone gone. And as you can see, we've closed a candle right through. And this indicates that we're actually eating through any liquidity that was here at that zone in the past. So it is now a zone that I wouldn't really consider to still be a demand zone. So this is another example of using a supply and demand in the case of a trend trading strategy. We've located another halt in the market or another consolidation or a range. We've then broken out with a nice impulsive move. So we've created a demand around here, around this candle here, and we've headed up. Now you may have entered a short position here for whatever reason. Maybe it was this lower high or maybe even this break of trend here. But let's just say we got into a trend trading short position. Well, this demand zone would now most likely be our target of where we would look to take profit. Now there is another demand zone through here, which I'll place in just to see how well this level is also respected, but our overall target might be down here. Actually, while I'm there, we can also just see that there was another level of demand here that was respected. So you can see we had this consolidation, the market ran out. So say you got into a short position on this lower high, then here is your first area of interest. If we break this, that's your second area of interest. If we break that, then this is your third area of interest. So you can see here how well these levels got respected. We had a nice bounce there. We had another bounce there. Eventually we broke through this level. We had a good buy up in this zone. However, it was a little bit too late and it had already been pierced. So we pretty much disregard this level. And then we continue to come down. You can see we had a nice bounce here again. And there was another bounce here. So we definitely were respecting this level of demand. However, eventually we broke through. So you'd now also consider this to be gone. So here I just want to show you how you can use supply zones or supply blocks as potential targets if you're using another strategy like, for example, trend trading. I'm just going to quickly turn off the volume to get that out of our way. So you can see here I've located two ranges that we had the market fall away. So this is indicating a level of supply. Again, here we had a little pause in the market and we had a bit of a range before the market fell away again. So this is another level of supply. Now, if we were in a long position from down here, say we're trend trading using EMAs or just trend lines or Fibonacci, whatever it is you might be doing, you're entering long positions, and maybe you're stacking long positions as we continue to go up on this trend. What you may look to do is to take profits when we actually come up and reach our supply target. And you can see here how our supply target from here was well respected. We actually had a really good rejection here. The market was holding as resistance from this level, but then we eventually chewed through that level. So once we've chewed through that level, we've got to almost assume that that supply block is now disappeared, and we're now looking at our next supply target, which is up here. Now you can see here we had that nice big green rally here, and you can see we perfectly touched here, respected this level of supply, and that might have been another place that you took profit. Again, we chewed through this level, so it's now considered gone as well. So here's another example of a demand zone. Now you can see this range with this impulsive move as the volume started to increase. So I'd be looking at this last bearish candle before we started to move up on this rally. So I'd go from wick probably to the body to create a nice demand zone. All right, and now we're going to push play. Speed this up a little bit. Okay, now the other thing I want to look at now is we actually started to range again up here, right? And then the market started to fall away as volume increased. So we actually also have a supply block up here as well. So again, I'm looking at that, might tighten that up a little bit there. So we're looking at that last bullish candle before the market started to tank away. So I'm looking from the base of this bullish candle here to the very high wick of that bearish candle. So what we're going to do now is range trade this order block by placing a long position with our stop loss just below our demand zone, and we can have our target up at our supply zone. So you can see they generally offer a pretty high risk to reward. They're generally a fairly large move. They'll take a few weeks, sometimes months to play out, but these can offer really good potential trades. So I'm just going to push play now and see how this goes along. Okay, so we would have taken profit at our previous supply zone. Now you've got another choice here. You can actually open up a short position back on our supply block. So if we were to just replay this a little bit, and let's just assume that we got ourselves into a nice position or a swing position. So we basically closed down our long position and flipped our bag to a short position. We'd now be trading this back down. Very similar risk to reward, even a little bit higher in this case. And you can see here, we actually pierced through our demand. So now we wouldn't necessarily be considering placing another long position. Now, you may have actually closed your short position here and maybe even opened long, assuming this was going to be a bounce, and then you may have been stopped out there. So let me just delete this and just show you for a little bit of transparency of how this may have not gone in your favor. If you wanted to swing this range once again with a stop loss below your demand, you would have been stopped out here, and you may or may not have wanted to jump back into this market. Me personally, I would have assumed that this range of supply and demand is now broken, and I wouldn't bother trying to jump back into this to trade it up. I'd actually let the market settle a little bit just in case it did decide to come down a little bit further. But as you can see, you would have almost got another trade in here if your stop loss was a little bit looser, or maybe if you jump back in on a second retest. But you can still see how these supply and demand blocks are still being respected over a longer period of time. It's worth mentioning that these zones can be respected for a long period of time, anywhere from weeks, months, even years, depending on the market you're trading. Whether or not it's because there's still significant orders left on the table, or it's just a case of other traders all targeting the same levels, I guess we'll never know. But that's about it. Pretty simple stuff, really. I really hope you guys learned something from today. Feel free to leave a comment below with any ideas or suggestions for future videos. I'll see you next time.